Hello, everyone, and welcome back to SALT Talks. My name is John Darcy. I'm the managing director of SALT, which is a global thought leadership forum and networking platform at the intersection of finance, technology, and public policy. SALT Talks are a digital interview series with leading investors, creators, and thinkers. And our goal on these SALT Talks is the same as our goal at our SALT conferences, which we're excited to resume here in September of 2021 in our home city of New York. But our goal at the conferences and on these talks is to provide a window into the mind of subject matter experts, as well as provide a platform for what we think are big ideas that are shaping the future. And we're very excited today to welcome Scott Sperling to SALT Talks. Scott is the co-CEO of Thomas H. Lee Partners and a member of the firm's management and investment committees. Mr. Sperling's current and prior directorships include Thermo Fisher Scientific Corp., the Madison Square Garden Company, Experian, Warner Music Group, Houghton Mifflin, Univision Communications, iHeartMedia, The Learning Company, Wyndham Hotels, and many, many more private companies. Prior to joining Thomas H. Lee Partners, Mr. Sperling was a managing partner and of the affiliate of Harvard Management Company that managed all alternative asset classes for Harvard University's endowment fund. He is the chairman of Mass General Brigham, the parent of the Harvard Teaching Hospitals, Massachusetts General Hospital and Brigham and Women's Hospital, as well as a number of leading specialty and community hospitals and physicians practice groups. He's a chairman emeritus of the City Center for Performing Arts and Wang Theater. He's also a member of each of Harvard Business School Board of Dean's Advisors, the Harvard University Committee on University Resources, and the Harvard Business School's Boch Centre for Entrepreneurship. He holds an MBA from Harvard Business School and a bachelor's degree from Purdue University. And hosting today's talk is Anthony Scaramucci, who's the founder and managing partner of Skybridge Capital, which is a global alternative investment firm. And with that, I'll turn it over to Anthony for the interview.
Well, first of all, it's a great pleasure to have you on with us, Scott. I apologize for my attire. I feel like I don't have the standard uniform on. Maybe next time, although I probably can't fit into my suit anymore. I didn't get COVID-19, Scott, but I got the 19 pounds.
19 pounds, exactly.
I got the 19 pounds associated with COVID-19. So you had this amazing career. And for congratulations, but I want you, if you don't mind, we have a lot of young listeners, and I want you to go back to the early days of what you were thinking about before your career started, and then how did it manifest itself pursuant to that arc of your plans, and how did it deviate?
Well, I would say that, one thing I found to be a useful characteristic personally, and I know other people have a different view on this, is I don't really plan ahead very much. And so it's hard to get disappointed. And I would have to say that, I was very fortunate to find some really interesting opportunities with great leaders early in my career. And that really helped guide me to where I am today. I haven't worked for very many firms in my life. So I will acknowledge it's a small sample set, but I started off coming out of business school at BCG, which was a great experience in days when strategy consulting was still very young. This was 40 years ago. And then I was given the opportunity at a young age to start and then manage all of the alternative asset classes for the firm that manages Harvard's endowment fund. And, being involved in venture capital and buyouts and real estate and commodities back in the mid and early 80s, all the way through the mid 90s was, an opportunity to see a lot of really smart and energetic people do some amazing things in areas that had not yet been exploited. And then for the last 26, 27 years, to lead an organization like THL has been a real blessing. So it's been a very fortunate set of circumstances.
Your portfolio, like everybody's, got impacted by COVID-19. So tell us what happened. Tell us what you guys did to adapt and pivot, and tell us what your outlook is during this recovery that we're at.
So we've been fortunate that our strategy involves identifying very specific subsectors within three broad areas: financial services and fintech, healthcare, and what we call technology and business solutions. that have very strong secular growth drivers to them. And there are a lot of people out there doing similar sorts of things of what may be called thematic investing. We try to drill down and just become incredibly expert in a few handful of areas within those three broad sectors. And those areas, again, are typified by very strong, sustainable secular growth, interesting return on invested capital characteristics, and tend to be larger addressable markets. And the benefit of that during the downturn was that we didn't see as much negative impact as you might see with a more broadly constructed portfolio. So we were fortunate in that regard. And like many others, we have significant operating capability resident within our firm. We have a team of operating experts that were able to go to the portfolio companies and help them manage through what could have been a difficult period. So we were generally in a pretty good spot to start with. And as the world got better pretty quickly, as we all know, from a business perspective, even though it's been horrific in terms of the impact on lots and lots of people, both in this country and around the world. From a business perspective, we saw very significant growth return reasonably quickly, and are fortunate, again, to be in areas that are tending to be much stronger growers than the broad economy.
I want you to react to this. Would it be fair to say that private equity now, and specifically to T.H. Lee, is focusing more on growth areas and less sort of on what I would call unlocking synergies due to consolidation? Or where do you see the vision for your firm and private equity in general going forward from here?
So there's definitely been a shift over the course of the last 20 years to growthier spaces. Now, our firm's heritage was always middle market growth, so it fits reasonably well with what we're doing, but where there is growth is different. So years ago, we were very big players in consumer and retail, and it was a great space for us. We don't find that same set of strong secular growth drivers in more traditional consumer and retail anymore. And so the shift has been to more technology-based companies that serve those markets. And I think there are a lot of firms in our industry that have focused in on those kinds of areas. And we're always trying to look for spaces where there is a dynamic of change that can lead to relatively explosive growth. So automation is a space that we've been a major player in for quite a while. It is a space that plays to the need of companies in the United States and around the globe to help support their existing employees, take away the more mundane and labor intensive tasks that don't require high skill sets, and allow their employees to focus on other areas while increasing productivity. And as we are in a period where there are projected labor shortages in lots of different places, automation is going to play a key role in bridging the gap between where we are today and where we might be in terms of the demand for labor that can't be met.
So, I'm of the theory that automation and technological innovation is always good long-term for the economy and also for the working class, because you just improve the quality of life and you scale up. It's the same reason why the horseless carriage, replacing the people that had labor associated with horses, they seem to have also done better. Am I right about that? Should we be optimistic about the furtherance of automation or pessimistic?
I think you're exactly right about the impact of automation long-term and even in the intermediate term, because the need to increase productivity and allow employees to see their compensation levels rise and also be able to produce products at prices that do not create significant inflation can only be solved with increasing automation. And that automation takes place in lots of different spheres, certainly on the factory floor, in distribution and warehouse centers, We've seen a significant bump in the amount of automation that is being utilized. Again, in most cases, it takes the place of that labor that can't be found and allows existing employees to both get higher hourly wages as well as focus on higher value-added tasks, all of which contribute to productivity. But we're also seeing automation in offices, in healthcare, that allow for much more productive output that, again, allows us to manage the cost of providing goods and services in ways that can avoid inflationary prices, as well as come up with many better solutions in areas where the automation actually provides functionality that doesn't exist or can't exist without it. And so in healthcare, automation, whether it's in surgical robots or in pathology and radiology, will have a significant impact on our ability to come up with better solutions for patients.
So, Scott, I want to follow up on the healthcare piece because that's something that we're keenly interested here at SALT and at SkyBridge. We've launched an early stage, and not just biotechnology fund, but investing in earlier stages in private healthcare-oriented companies. And I know it's something that you guys focus on a lot over there at THL. You mentioned a couple of examples of technology, but how has technology and private investment really accelerated a lot of these advances that we've seen in the healthcare sector coming out of the pandemic and even in the pandemic? And what part of those changes do you think are permanent that are going to come out of the pandemic long term?
So, one of the things that's really crucial in healthcare is the ability to reduce total medical expense of the cost of care provision while providing greater access to patients to advanced therapeutics to be able to more easily reach their primary care provider and certainly high specialty care providers. Things like telehealth, the use of digital technologies is one of the obvious things that we've seen. There's an explosion of growth in that during the pandemic by necessity. I think it's important that the government continues to support the utilization of those technologies because it's the way that people want to receive care in many circumstances. And when you look at the cost of care overall, it's really people who are of tertiary or quaternary acuity, the really sick patients, that cost the system the most. And if we get better compliance because people can use digital and telehealth capabilities, that would be a significant improvement and can hold down the overall cost of the total medical expense. The other area that you're seeing growth in science are the capabilities that you see, whether it's next generation sequencing technologies, lots of technologies that continue to be developed in ways that dramatically reduce the cost of drug development and the ability to, again, provide therapeutics and diagnostics to patients at ever lower cost. And you're going to see opportunities in lots of different ways in order to accomplish what I've just described. Back in the 1990s, we knew that science was growing. We weren't sure at THL that we were that good at being able to predict which biotechnology company or which specific therapeutic a pharma was developing would be a winner. But we knew it was all growing. And so, we decided to buy a company called Fisher Scientific, which was the largest provider of stuff to the world of science, clinical, research, industrial in the world. And we paid, about $1.5 billion for it in those days. And today, Thermo Fisher, where I'm still on the board, probably has a enterprise value in excess of $200 billion because it really grew. And it really grew because it brought together a set of technologies and capabilities that really met the needs of its customer base. Today, when you look at private equity, we're continuing to look for ways to support companies and buy companies that can help the pharma and biotech innovators do their job better and more effectively. So you've seen CROs, the clinical research organizations that do a lot of the testing, grow in terms of revenues, profits, and market caps. You see a lot of other players who provide tools and capabilities to both healthcare providers, but also to the developers of these therapeutics and diagnostics. And those are opportunities that really have become very attractive to people in our industry, and that we've been a major player in.
Yeah, we had Walter Isaacson recently on a Salt Talk, who wrote the book called The Code Breakers about Jennifer Doudna and her team that developed the CRISPR technology and continues to lead the genomics revolution. So from an investment perspective, and maybe it's comparable, but are you more excited about more the telehealth preventative medicine type trends, or more interested in some of those more moonshot oriented goals? I know you guys are investing a lot in the infrastructure around companies that are supporting that genomics revolution, but what types of companies? Is it more the pharma, biotech oriented companies that you guys get most excited about and supporting the infrastructure around that? Or is it more the telehealth and just the remaking of the healthcare system in general?
I would say that when we identify these subsectors, within healthcare, again, our focus is on things that can have that strong secular growth. And I'd say you've identified two areas that fall into those subsectors. And so we're really very active in both spaces. And we're looking for ways that we can help providers of care reduce total medical expense and reduce the cost to the entire system of providing high quality care from birth through end of life. And there are lots of different opportunities that the industry has been able to support in those spaces. Again, bringing down the cost of care while improving access for patients more broadly to that care. But we're also very interested in supporting the growth of science, broadly defined, as it helps develop better therapeutics, better diagnostics, better medical devices. And there are lots of different areas that flow into providing that infrastructure in ways that allow the pharma companies and the biotech companies to focus on their most important value added, which is the innovation itself of these phenomenal therapeutic and diagnostic drugs and capabilities.
I want to step back, take you up to 30,000 feet for a second, and I want you to think about the next killer technology, the next killer drug. And so, the invention of statins, the introduction of penicillin, what is next on the horizon? Is it a immunotherapy that can be delivered? Is it a vaccine like the ones that Walter Isaacson was talking about in Code Breakers? What, in your mind, you sit at an interesting seat because you've got private companies, public companies, and you sit on the board of a hospital. What's the next killer app for medicine?
So one of the things that has been great about chairing the board of the Mass General Brigham, which is the largest research system in the country, largest recipient of NIH.
John and I are coming to you when we get sick.
Okay, there you go.
I just want to make sure you know that, Scott. That's what we're asking the question. We're digging.
And also because we are such a large provider of high-end clinical care, you can see not only the flow of basic science that develops in these areas, but I've just been amazed at the translation, what they call the translational research that's done, taking it from those basic ideas to things that actually can work in patients, and the nature of how the care has evolved. And you've mentioned some key areas. Cell and gene therapies of all sorts is going to be an enormous space. The development of these vaccines particularly the mRNA-based ones that we've seen from Moderna and Pfizer, and there are a couple of other players out there working on that. It's not only amazing that they were developed as quickly as they were, but perhaps even more impressed. I was going to say more importantly, but I'm not sure you can say more importantly when it came to dealing with the COVID vaccines. But in terms of longer term benefit, these are platforms that can be utilized to develop many other effective vaccines and therapeutics. Remembering that the original target for most of the mRNA pioneers was cancer. And so we're looking at ways that we can utilize a range of different technologies to deal with some of the most devastating diseases that we have. And so, there's the using the mRNA platform to help the body either through vaccine or effectively immunotherapies on things like cancer and a number of other difficult conditions. Then you have the ability to use other forms of immunotherapies that are continuing to evolve in ways that become more effective longer by bringing cocktails of capability to bear, again, against cancers and potentially some other disease states. And then you have things like CAR T that, again, are breakthrough technologies that are going to have a big impact on a number of the most difficult cancers in terms of the nature of treatment out there. And so, I'm very encouraged that the pace of innovation is going to continue to increase, and the nature of what we're innovating is going to continue to have ever greater impact on a number of the most devastating diseases. Now, one of the issues with all of this is that, particularly early on, the cost of these, particularly therapeutics, isn't incredibly high. And so, while I'm highly encouraged by the advent of and the accelerated introduction of new therapeutics, as a system, we also have to think about the long-term cost, not necessarily that sticker shock when somebody says, that's a $250,000 or $1 million bill for that solving that particular disease. And we saw that with Hep C, for example.
And it's fascinating. I want to shift gears for a second. What I love about TH Lee and your work is you're keeping us healthy, and then you're also making us rich through financial services. And so I want to put that hat on for a second, and I want you to talk about the future of financial services. Jamie Dimon recently says he's worried about neobanking. He's worried about the fintech space. The costs associated with fintech relative to the old school bricks and mortar. They sort of feel like they're getting assaulted the way book publishing did, as an example, or other industries. Where do you see financial services going? Where's the puck going, and where's TH Lee going to be?
So I break into a couple of different areas. The first is the application of technology, the so-called fintech in many of the traditional banking, mortgage servicing, mortgage origination spaces. And, as we've been involved, it's publicly known, in a number of the leading companies in that space, whether it's FIS, Fidelity National Information Services, or Black Knight Financial, and a number of others. These are companies that provide a set of services broadly to the industry through fintech platforms that even people like Jamie use, because they can do it at a much lower cost with greater functionality. And you have a number of companies out there in the industry. These are now large publicly traded companies that continue to grow reasonably rapidly. You then have other spaces that have not had that form of technology brought to bear on the value chain as much. I think in insurance, there are lots of opportunities in the insurance industry when you look at that very involved and evolving value chain where you have underwriters and agents and lots of people in between, where you can increase the efficiency and delivery of the service to both customers and to all of the players along that value chain. And so I think there's going to be a lot of opportunities there. We're talking about wealth management, and obviously we've seen evolution in the wealth management space, somewhat due to regulatory changes, somewhat due to the ability, again, to utilize technology in ways that remove administrative cost and burden from wealth advisors and allow them to focus, again, on the highest value added part of what they do. So I think you're going to continue to see a lot of opportunity in the financial services sector to apply technology all along the various value chains and in ways that will improve the performance and delivery of services to customers and clients. At the same time, you have a lot of other things going on, particularly in the digital currency world, that I'm not sure we've gotten our arms around yet. I note the commentary from coming out of the Berkshire annual meeting about Bitcoin being one of the worst things that ever happened, and lots of comments about Doge.
Seemed a little angry. I
don't know enough. I actually don't know enough.
I'm just saying, Scott. Charlie Munger wrote a book, Poor Charlie's Almanac. He thinks he's reincarnated from Ben Franklin, and in the book he says, "Be dispassionate about your investing," but he seems upset about Bitcoin. It's sort of. I don't know, but we'll see who's right. There'll be a big tug of war. I'm going to turn it over to John Darcy, who has questions from our audience, which he's collected. But I want to ask you this question, and I want you to put your valuation hat on. Things seem pretty rich. Now we both know that interest rates are the physical gravity of financial assets. So they're at zero, they're propelling assets higher. But in your expertise, your decades of doing this, are the valuations too high? Did they give you pause? Did they give you pause in financial services? I've been in financial services for 30 years, 33 to be exact. I've never seen valuations like this. So are we okay here, or are you worried?
I'm always worried. And I've been worried, for 6 years. I've thought we were within a couple of years of a recession.
Now I'm going to call you out on that. You're not really that worried, Sperling, because you would have lost your hair a long time ago if you were really that worried. Okay? You can tell that John and I are not that worried. But the truth is that the valuations are, I don't know, they seem stratospheric.
Yeah. So, we've seen continued increase in valuation. Now, I would say that in my view, valuations need to be tethered on two things. One is, what is a sustainable growth rate? And there are lots of businesses, and the market has clearly shifted in terms of the proportion of market cap in companies that are growing reasonably fast versus, the slower growing, more industrial kind of companies that had historically made up a larger percentage of the market cap. And so when you look overall, if you can anchor a multiple against, first and foremost, against sustainable growth rates, that's probably analytically what makes sense. And it's certainly the case that, we have lots of potentially fast growing opportunities in the stock market today. But it's also true that there are lots of things that are getting valued well above what would be justified analytically by true sustainable growth rates. So you have to worry a bit about that. And the second piece is clearly interest rates, because everything has to be tethered to some form of a discount rate, which we have been in low longer than anybody had ever expected. One of the potentially worrisome aspects about the direction that our fiscal policy is going is that that might change the interest rate formulation in ways that are somewhat unpredictable. We all like to believe we can manage the soft landings, as they used to say, or we can manage to a 2 to 2.5% inflation rate. But it's not clear. I mean, I have the unfortunate history of having lived through, in my business career, I think 6 recessions, and they're always you're always taken by surprise by how bad they can be. And there's a point in the recession where you're always taken by surprise about how good it could be on the way out. We're certainly in that point where, we'd like to believe we can manage any negative that happens, including potentially inflation, and keep it under control. And I hope that's the case. But, one needs to be a little bit wary, I think, given we're in somewhat unprecedented territory here in terms of fiscal stimulus if all of this goes through. We're already seeing enormous inflation at the basic and intermediate goods level. That eventually is going to get passed through to consumers. And
no, it's worse.
I don't know.
Oh, I'm going to turn it over to Darcy, but I promise you this: when you turn 97, Sperling, I'm going to be asking you the very same question. I just want to see how emotional you're going to be when you're 97 and you're a great grandfather.
Man, if I can get to anywhere.
But right now, you're very dispassionate. I was impressed with your very dispassionate analysis. But go ahead, Mr. Darcy.
Well, using all those advanced therapeutics that Scott is helping to unlock through his investing, I think he has a good chance to live to 97 and beyond. And also looks like he's in great shape, so he's taking care of himself. But
let's pray.
Yeah, and I was born in October.
It's actually the secret of my entire career: the prayer.
Right. There you
Amen.
go. That's the most important thing. I mean, I was born in October of 1987, so I like to think worrying about financial markets is somehow ingrained in my DNA, given the timing of my birth around that crash. But I want to go back to Bitcoin for a second, because it's something that
he just attacked you and me, right? Because Scott, you know exactly where you were on the 87 crash. As do I. This guy was like in a neonatal facility. That was literally a karate. That was like literally, he's in the center box on the Zoom call. That was like taking a karate chop at both of us at the same time. Go ahead, Darcy.
Okay, so deftly, so nicely.
I'm on the ground bleeding. Okay, Scott's half listening now. Go ahead, Darcy.
So back in millennial mode, I want to ask you about Bitcoin, Scott. And you indicated that you don't necessarily have huge depth of knowledge in the area. And I think a lot of people have been on a crash course to learn more about it over the last year. And you've seen people like Jamie Dimon that Anthony referenced earlier, across David Solomon, you name every big bank CEO has been forced to go from dismissing this technology to saying so many people are asking for it. We have to figure out what our approach is as a company to delivering these solutions to clients. You mentioned FIS as an investment of yours. They partnered recently with one of our close friends and partners, NYDIG, to basically they're bringing the ability for traditional banks to offer digital asset integration into their core custodial offerings. So as a firm, what do you guys think about this massive rise that we've seen in Bitcoin? Most recently, Ethereum and smart contracts have been exploding at even a faster rate than Bitcoin. What do you guys make of the digital asset ecosystem as a firm? And do you think you'll ever make investments into that space, or you'll focus more tangentially on firms like FIS that are powering the infrastructure in the same way that you're investing in infrastructure around the biotechnology and pharmaceutical boom?
I think the quick answer to your last question is we will focus on the infrastructure pieces. And again, partly because I just don't think we're always smart enough to pick specific winners in some of these other kinds of areas. But, by serving everyone, you actually can participate in what is a strong area of thematic growth. Blockchain technology is definitely an important technology. And that has application that goes well beyond Bitcoin or any other digital currency. I think people wonder about digital currencies because we haven't seen anything like it in the sense that, we're used to sovereigns having control of currency. And sovereign does not have control of these currencies. And when it doesn't have control of a currency, there are lots of potential, I guess I would call them unintended consequences that can occur. And we've already seen a couple of countries, Turkey, India, for example, basically say, we're going to outlaw this because we can't have that. That is undercutting our ability to manage the monetary policy, at the very least, of our economy and maybe, beyond. And so, I wonder at some point, will we have unlimited digital currencies that are posing as alternatives to our sovereign currency? Now, that's particularly important for the United States because, as you know, one of the reasons we're able to do what we can do in terms of borrowing is that we are the reserve currency of the world. And that's a position that is already going to be under challenge by the Chinese and I think the European Union. And they will use their own digital technologies in ways that allow them to challenge the status of the United States as the only true reserve currency right now. And so I think we have to watch that carefully. But as Bitcoin becomes more important and it is more important to control the data flow of who owns it and how they're transacting, it may change the underlying value of that, or perhaps, there's a stroke of the pen risk that says it just has to go away. Certainly when you go to, the ones that, many people have commented on, like Dogecoin, where there is no limit on supply. It was done as a joke. You just wonder, are we in tulip bulb territory with things like that? So,
right.
Again, I'm speaking, but I don't know enough to be relied upon on any of this. I'm just raising some of the issues that would occur when you have this kind of situation generally.
So maybe that's what Charlie Munger should have said at the Berkshire Hathaway annual meeting, and been a little bit more dispassionate about it, but it's a conversation for another day. So we've talked about some sectors that you're very enthusiastic about, things in the healthcare space, certain areas of financial services, automation generally. There's been an explosion in tons of different asset classes, mostly focused on technology, frankly, but some that, there's some suspicion from wary investors that the current rate of growth is not sustainable and that there's pockets of the market. And we've already seen sort of steep pullbacks and even a lot of public companies that exploded during the pandemic. But are there any specific sectors or subsectors that you're most concerned about, that as an investor, you've come across deals and said, this makes absolutely no sense. And if I could had a mechanism to do it, I would be short this sector? What areas are you most concerned about or skeptical about?
The pressure on the industrial sector, given, again, the move in the pricing of raw materials and intermediate goods, is something that, I know it's becoming a popular play in the markets now as we see a return to normalcy from the pandemic, because those areas were most adversely affected. But I think it's worth watching what happens to the cost structure and the ability to sustain strong margin in those areas. Again, I think looking at the impact on their margins because of the increasing, in fact, in many cases, dramatically increased cost of raw materials and intermediate goods. But, offsetting that is the more rapid adoption of automation and software tools that actually reduce overall system cost in sometimes dramatic ways.
So the last question I have for you is, I think people look at the returns for a middle market PE firm and say, man, that looks like fun to invest like that and achieve that level of returns. But there's so much operational expertise that goes into the execution of a lot of these business turnarounds and growth investments that you guys make. How important is that? And what type of value do you guys offer as investors on an operating capacity to companies that you invest in?
So, and we've talked a lot about this publicly over time, but our strategy has been to be able to provide a significant level of operating expertise that's particularly valuable to middle market companies. And, there are a number of folks in private equity who are oriented in the same way, of being able to provide operating experts on-site at companies in ways that allow us to improve the key business processes of these companies. And we have found that particularly in the world of rising prices and multiples, that is a very important driver of value. And I think for the industry, the private equity industry, it's an important value added that we bring to the economy. Now, there are some firms that will focus on not growth companies, but areas where there are significant headwinds. And in order to help reposition companies, whether they're retailers, bricks and mortar retailers, or other maybe older industrial type companies, they'll bring their own expertise to bear in those areas. Ours is in helping more rapidly growing companies really be able to sustain and, in fact, increase their growth rates in ways that are sustainable over the long term.
Right. And, I think a lot of people that aren't as familiar with the industry, they hear the word private equity and they think of Gordon Gekko, but you guys are truly, helping to spur innovation and growth in a way that doesn't fit with necessarily some people's archetype of what private equity looks like.
And clearly we don't always get it right.
Right.
And, particularly as you may try to help transform an old economy company into a new one, there have been lots of challenges. But there's really nobody else stepping up to try to do those things. I think the industry overall, is trying to provide value in ways that are not otherwise available to a broad set of companies that in this very dynamic world are perhaps have been on the wrong side of technological change and innovation, but still have lots of employees and lots of reasons to try to survive and in fact thrive.
Well, Scott, congratulations on all the work you guys are doing and all the success you've had. Thanks so much for joining us here on Salt Talks. Anthony, you have any final word for Scott before we let him go?
No, listen, it's a pleasure to hear you talk. I'm coming to you when I get sick.
Do that.
I'm coming to you when I need to
hopefully not for a long time.
Hopefully not for a long time. I'm coming to you when I need to reinvent my financial services business. You're sort of stuck with us now, okay? It's too bad. All right.
You know where to reach me.
All right. Well, we appreciate it. It was a real pleasure to have you on, and I found the conversation fascinating. Thank you again, Scott.
Thanks so much. Take care.
And thank you, everybody, for tuning into today's Salt Talk with Scott Sperling of Thomas H. Lee Partners. Just a reminder, if you missed any part of this talk or any of our previous Salt Talks, you can access them all on our website at salt.org/talks. or on our YouTube channel, which is called SaltTube. We're on social media. Please follow us if you're on the various channels. Twitter is where we're most active. @SaltConference is our handle. We're also on LinkedIn, Instagram, and Facebook. And please spread the word about these Salt Talks. We love educating a broader audience of people as opposed to just being able to speak to 2,000 plus people at our annual conferences that we do in the U.S. and abroad. We've really enjoyed this Salt Talk series, so please spread the word. And on behalf of Anthony and the entire Salt team, this is John Darcy signing off from Salt Talks for today. We hope to see you back here again soon.